Good evening, all of you. A warm welcome to the last panel discussion of this two-day third SEBI NISM conference. The emergence of the digital economy has fundamentally altered the way in which producers, consumers, and suppliers interact, the way in which businesses operate, function, deliver products and services. This has resulted in a widespread disruption to the traditional businesses across different sectors, be it pharma, be it healthcare, be it banking. There has been widespread disruptions on the one hand, and on the other hand, new businesses and new business opportunities have been created in the past few years, which have been leveraging the technology as a key resource. These are popularly known as the new age tech companies. Valuation of these new age tech companies actually poses various challenges, mainly because of the reasons, I would say, mainly the important reason being unestablished business models where there is no past data with respect to how these businesses really function on the one hand. And then on the other hand, these businesses have characteristics of explosive growth, and if they don't succeed, they tend to fall as rapidly and steeply as they have grown. So these uncertainties with respect to data and information creates key challenges while models are built to value such businesses. As investors, we also see huge differences to values which are attributed to these businesses across various media and newspapers, etc. Valuation community needs to think about what kind of models and how these models can incorporate these uncertainties, capture them, and provide more precise valuations for these new age technology companies. Rightly so, our today's panel discussion is centered around valuation of new age tech companies. We have really a very, very distinguished set of panelists, eminent panelists. We have with us Sri Mohandas, Chairman of Manipal Global Education, India. We have Sanjeev Bikhchandani, Founder and Executive Vice Chairman of InfoEdge India Limited. We have Sri Prashant, Jain, Executive Director and Chief Investment Officer of HDFC Mutual Funds. And we have Sri Manoj, Dengla, Partner of Arpwood Partners Limited. We have equally well-known moderator, Ms. Nisha Poddar, Anchor and Editor of the CNBC TV 18. A warm welcome to all our panelists and moderators. Without actually spending the time on detailed introduction of these panelists to our guests, I would like to hand over. They need no introduction at all, and therefore I would like to hand over to Nisha. Over to you, ma'am.
Thank you so much. Thanks so much for your kind words. And yes, indeed, it's a very topical subject at this point, very relevant in these times. And a very distinguished panel here with me, and I will try to draw as much expertise as they can bring to the table on how to really decipher the valuations of these new age tech companies. We have seen a frenzy of IPOs, and while the markets are right now shaky because of geopolitics, but it was clearly the decline of the newly listed tech, new age tech companies that we saw globally and in India, much ahead of some of these jitters really coming to the market, maybe US Fed tightening the interest rates or else the geopolitical issues erupting. So it cannot be totally ascribed to that. Irrespective of that, standalone, how to value these companies, a lot of them have fallen way below their IPO pricing. Let me begin with Mohandas Pai. Mohandas Pai, I know you from your days at Infosys. That was a time when new age tech companies had come to the IPO market. That round versus this round, how do you differentiate? And do you think we went wrong in this at this time due to the frenzy that we saw and the liquidity flush that we saw from the global investors?
Well, Nisha, before I go on to a comparison, let me talk about what is happening now. These are all disruptive digital companies. They're coming out with new models to disrupt existing models. So they lack a history. They lack knowledge about the impact of disruption on traditional industries. And they are high growth companies. And because of high growth, they'll always be loss-making for many years. Loss-making because they will invest in 2 years what traditional industries will invest, say, in 10 years and build up losses. And most of the entrepreneurs are first-time entrepreneurs doing it and coming out with very new ideas. That's why they're very disruptive. So you cannot apply traditional discounting models or comparative company models because they don't exist so far, or any other model to value them when they go to the public markets. Thus, we got to understand they're very disruptive. Traditionally, globally, throughout history, such kind of disruptive companies have always got a high valuation because I believe the market values growth more than anything else. Growth because in 2 or 3 years, you can create new models, you can do many things, and that's why the valuation will always be high. Third, there is curiosity, there is scarcity, there is romance in all these companies, and the dream that they're going to do something new. And that's why they get very high valuation. It happens all over. For example, when Infi came to the market, I remember in 93, it was undersubscribed, and then we grew. And by 2000, we had a multiple of sales of 55, a PE of 200, except that we are profit making. And for the next 4 years, the market value went down from 50,000 crores in 2000 to about maybe 35,000 crores, coming up from 29,000 crores. But the EPS went up by 43% CAGR in 4 years because we are profit making and we are high growth. We're getting rewarded for growth, but we are in the midst of the NASDAQ boom. At the time of the boom, I remember when we were listed on the NASDAQ, our market value went up by $15 billion in 2 weeks and came down by $10 billion in 1 week. We did not know why it went up by 15, why it came down by 10. We just looked at the figures. We are happy. Then, when it came down, we said, oh my God, what happened? All right. So now all these companies who come to the market have come to the market on basis of the valuation between the knowledgeable, willing buyer and the knowledgeable, willing seller. SEBI has come out with great norms. You must remember that, where only 10% is given to unsophisticated retail investors for so-called loss-making companies. And that's been the market for many times. Most of them are anchor investors. Most of them are QIBs. Most of them are so-called sophisticated sophisticated players. They valued the company. They had an IPO. The price went up. And later, the market came down. But there's one difference between what we did when we came to the market and what these people are doing. There's a great degree of arrogance in the air to say, we are the great achievers without proving that you are an achiever. There's a great degree of arrogance in saying, Sanjeev knows this. I told him that we'll not talk to the analysts, we'll not explain, we'll meet them once in 9 months, 12 months, not knowing once you're in the public market, you have to market your company. You have to meet investors. I used to meet 300 investors every year from 94. Now that we raise money, and you got to sell them your model. You got to make them understand. So they have trust and confidence in you. You cannot say, take it or leave it. I'm the greatest on this planet. Because the public market, investors have hundreds of companies of choice. The analysts, you write good stories, then you go up, then they'll write bad stories, then you come down and they make money both ways. The brokers make money both ways. They're a very different market from a private market. I think that is where they failed. Well, the valuation is the valuation, but where they failed is not going to the market, not doing one thing. And in last point, in case of one company by saying, oh, I'm profitable. So you're changing the entire model from growth to profit and EPS. And the EPS market is a very well-known market because everybody will fix the PE based on growth and say this should be the valuation. And if you miss your numbers with a very high PE, then you are history. I think all this is happening. But this is the nature of the beast. These are cycles that happen at periodic intervals. We just have to take it and then watch what happens.
That's right. And Mohandas, your biggest takeaway from your answer, and that's why I wanted to strike a comparison between your Infosys days and how you responded to the market and spoke to the market once in the listed space, and compare that to the present day new age tech companies which have listed. Sanjeev Bikhchandani, you have in your portfolio some of the companies which have come to the listed market. How has been the experience, and do you also concur with the point made by Mohandas Pai on the public market approach of the new listed companies from the space?
Look, I will not comment either on Policy Bazaar or Zomato. It'll be inappropriate for me to do that because they're listed. I think
overall experience.
I think the questions should be addressed to them. I will tell you about what we have done, what we did, and I'll say upfront. I have told Mohandas by this earlier. The first time I met him in 2001, and at that time we had just raised a Series A, and I had told him that he was taking a session. I was attending a workshop. He was a faculty there in Goa. Mohan, you may or may not remember. And this in 2001, and we had just raised our only round of capital raise in 2000, and it looked like we were going under because that was a .com meltdown of that time. And I was bold enough to go to Mohandas Pai in the coffee break and tell him, look, Infosys for us, we are Info Edge, right? Infosys for us is a great inspiration. And you, in many ways, especially on corporate governance norms and standards, you are a role model for us. And one day we will also list. And we were probably 15 months from going under, right? And one day we'll also list and we'll also be valuable. And, thankfully it worked out that way, right? But, I think Mohan is totally right. And I'll tell you one thing. Public market investor relations is not a finance job. It's a customer relationship, sales and service job. And your investor is your customer if you're doing investor relations, right? Yes. And the truth is, all the 3 full-time directors in the company, the investor relations person, all of us do investor relations together, and we regard it as a customer service job. We must have knowledge of finance to be able to talk numbers, but it's not a finance job. And I think the more companies understand this, and if you've not been in sales, where you're doing direct B2B selling, and I started my working career in advertising in Lintas and client servicing, and that was a very humbling job. I was at the bottom of the totem pole, and I learned customer service there. And Those 3 years have taught me a lot. And so I still have the same service mindset. And so when I go out to meet investors, and I do that often, and now, of course, it's mostly on Zoom, that service attitude remains. You got to, within the law,
yes,
create trust across the table.
No, of course, Info Edge has been a pioneer and has been around for a very long time.
Nisha, if I can make a point, all these young people going for IPOs in these digital companies look at Sanjeev Bikhchandani as a role model. Because remember, he's for the first internet company to go public. And he has carried it so well. He's been to up and down, carried too well. But one thing that stands out, Sanjeev, is always communicated, he's always been honest, he's always met people, he's always been digital, and you could trust Sanjeev.
Yes.
So the trust factor is important. You have to build up the trust in the public markets.
That's right. Very important point made. Manoj, Dengla, how do you see the present situation and the kind of valuations that the IPOs came up with? Do you think a large part of it was really driven by the liquidity flush and also the very frequent fundraise rounds that took place just before the IPO?
So, Nisha, there are no new eras in public markets. It's new stories, new insiders, new pump and dump schemes, and new speculators, right? Eventually, the laws of gravity assert themselves. And we are seeing early days of that playing out. I fully agree with Mr. Pai and Sanjeev that some of these businesses will end up being breakout businesses and will demonstrate be a solid business model. But I do not see for a lot of these companies any path to ever making cash, right?
Yeah.
Just twisting a famous saying, GMV is vanity, cash flow is reality or sanity, whatever you call it, right? And an often quoted example by a lot of these startups is, hey, look at Jeff Bezos and Amazon. He kept burning money for so long. He was never profitable. What they do not talk about is Amazon was free cash flows positive in the 7th year of its existence. Open Jeff Bezos shareholder letters in 1997, 2 years after the company was set up. The guy talks about return on capital, guy talks about free cash flow, guy talks about customer service. What do we hear our current crop of startup founders talk about? Valuation, GMV, lifetime value, which are all unaudited, right? So I think you will see some breakouts eventually emerging from this current era of excess. But this is no different from any other era of excess, right? And as people say, that greed is the biggest, greed kind of trumps everything.
Right.
See that playing out, and valuations don't double every 3 months, which is what's happening in the last 2 years, right? And you are seeing the same insiders doing Series B, C, D, E, same set of people participating in each other's company, marking up the valuation, and then using that benchmark to price the public offering, right?
Yeah.
The only way you can get rid of this misalignment of incentive, and that's something I've proposed in the past, is to ban OFS in IPO if a company is loss making. We do not deprive companies of their ability to raise capital for growth. Let them raise capital for growth. Let the stock price settle down for 6 months. Let them figure out how their performance is. Let the market look at their operating metrics, and then allow the insiders to sell after 6 months.
All right. So very, very important suggestion coming in from Manoj. And yes, OFS, but timeline, Manoj, just before the IPO frenzy we saw, has been shortened from 1 year to 6 months. And I will come to Mohandas Pai on this, but Prashant Jain has just joined. Welcome, Prashant, to this very interesting discussion. You're on mute. I will field the next question to you. And just to give you a brief, Mohandas Pai as well as Sanjeev Bikhchandani, both from the new age tech companies world and closer to the Bangalore offices of these companies, they both felt that, the public market response probably of these new age companies wasn't as appropriate as it should have been, for the lack of a better word. Prashant, you are on the side of making those investment decisions. You're on the side of the companies making a pitch and then you taking a call with your money. How did your experience go with the new age tech companies? And without profits and profitability, do you have faith in these companies?
I think, see, there cannot be, to my mind, there is no one answer to this. And these represent a wide spectrum of companies, and some of them will turn out to be very strong companies. And there is sight to clear profitability in some of these businesses. But in many of these businesses, I think at least we are unable to experience or see that clear way to profitability. I think markets once in a while create excesses. We have seen that in 92, we saw it in tech in 2000, we saw it with infra in 2007. I think this was one such phase. And since these are early stage businesses, not mature, it is very easy to put in futuristic numbers, high growth rates, depending on what one feels like. So I think there were certain excesses that were there, but some of these businesses eventually will turn out to be very strong. Though I do feel that the currently prevailing extremely low cost of capital globally has also led to these excessive valuations. And as this cost of capital normalizes over the next few years, and also as the market gets a clearer sense of sustainable growth rates, margins, I think valuations should settle down.
Do you think the current carnage that we've seen in the market, Prashant, and these new age tech companies started sliding before that in sync with the global companies which are just listed as well? Do you think that now they've hit the bottom, or do you think that we still have to find the bottom in most of these companies?
So again, I don't think these are very diverse businesses. Their competitive position, the addressable markets, the operating leverage of these various businesses varies considerably from across these. So I don't think there could be any one answer. Though I do feel that the COVID, the lockdown kind of environment, which led to rapid digital adoption, also led to enhanced growth rates, and that also might have led to these excesses. As the real world opens up, as some business goes back to the physical world, as cost of capital normalizes, I think this dust will settle down. So I am not too perturbed by what has happened. This is acceptable in these markets. It has happened before. It will happen again. I think things will settle down over time, though there cannot be one answer to your question to my mind.
So, I get your point, Prashant, and a very important point that you made, which I have been harping on also, is that the flush of liquidity, which led to probably higher valuations, and that is fleeting in nature. Sanjeev Bikhchandani, yes.
Yeah, no, the point I wanted to make is that, look, $5 trillion makes everyone look smart. So the Fed infuses $5 trillion into the US economy, which finds its way everywhere except China, right? There's asset price inflation all around in public markets and private markets. So the Info Edge share price was, I would think, about 2,300 rupees just before COVID. It peaked around 7,500. Now, were our fundamentals more than 3x better? I mean, Prashant is, a former shareholder of ours. I'm sure he'll be skeptical of that, right? And it's corrected a bit since then. But so $5 trillion makes everyone look smart. It makes fund managers look smart. It makes founders look smart. And it's when the liquidity goes away that you figure out who is what and where, right? But as an entrepreneur, as a founder, as management, what you got to do is keep focusing on the fundamentals. Keep on improving your fundamentals. Keep on getting growth. Keep on, going through the COVID crisis and somehow surviving. Trying to get a profit, right? Do all the good things that matter, because eventually, see, there's one more truism. In life, in the long run, you will be valued off of earnings multiples. Now, the long run may be 5 years, 10 years, 15 years, but at some point in time in life, you will be valued off earnings multiples, which means you better get to earnings.
All right. So what's the bottom line is the key aspect.
But it may not be next 3 years, may not be next 5 years, but at some point in time, it will be for every company. I don't know, Mohan, if you agree with me.
Right. Nisha, let me make a different point, then I'll come to Sanjeev. Sure. I think most of these new age companies made very strategic errors in listing.
What were those errors? Please articulate, Mohandas.
Yes. Nisha, the fundamental point about listing is to get a valuation for your company, liquidity for your shareholders, and a good aftermarket. Yes. What matters is not the listed price. What matters is what happens afterwards. Now, Manoj made a very good point. I hope all of them are listening. A total offer for sale or a large offer for sales creates conflicts of interest.
Yes.
The people offering for sale want the highest price, and the highest price may not be the right price for the rest of the investors. Most of them offer 10%, 15%, and the 10%, 15% should not destroy the 90%, 85% value. And I think that's where they get carried away, because the bankers will, all of them, I experienced this all my life. I'm much more than most people here. I know what they do. They'll always want to sell at a higher price because they want the commission. And then after the deal is over, they go. And the market is good, they get it. But the key thing is very, very, very simple. If you want to list and you've been, running this company, what is important is what is the value after listing for 3 months, 6 months of the people who are not sold the stock, are the shareholders who have remained with the company and not been diluted. Now, let's say if you want to raise capital, you must dilute as less as possible, such that you create adequate liquidity and you create huge demand for your stock because of the shortage. The moment you create a shortage, after listing, people will come and buy. Second, the price at which you list should be less than the value that people are willing to pay. Let me make this point, less than the value. Because what matters is not the price you get at the listing, what happens after listing for the 80-90% of shareholders whose value will be appraised after listing. And the third thing, which is very, very important, is if you have an offer for sale, you've got to be extremely cautious, because an offer for sale creates conflict. Now, somebody who was valued at 1.5 billion goes to 5 billion, 7 billion, and believes in it in 1 year to say I'm worth 7 billion, whereas I'm 1.5 billion 9 months back. I think, I question the judgment. I have to keep quiet. I don't want to talk about people, but I'm just saying. So I think they made strategic errors in one, putting too much of money into the market, too much of liquidity or too much of money, to pricing it at what the market is willing to bear, not looking at what investors want. And 3, not taking care of the balance shareholders who are not part of the OFS or who will be hurt. And I would like to support companies which take money from the market to run the business more than an OFS, because when the money comes in, the company gets stronger. Then the existing shareholders later can sell after what Manoj said, 3 months, 6 months, or whatever. Because you see, once you list, it's not a one-time bang, right? It is a long term. You're going to be there for 15, 20 years. It's not a one-time event.
Yes.
You're going to be there
more democratic price discovery.
Yes,
so Mohandas, I'm so glad that you've articulated some of the very important points. Let me take them one by one. So Sanjeev, Bikhchandani, the trademark of the IPO season that we saw was also the exit to the investors more than the growth capital for the companies. And that's a point that has been very clearly articulated by Mohandas Pai. Now, if OFS is curtailed and if investor interest wasn't there to get an exit, this IPO wave wouldn't have happened. How do you see this particular situation? And especially when liquidity was driving up the valuations, do you think that the Indian market has been overutilized in this respect?
Look, if people bought shares at a price, these are institutional investors. They're smart. If people bought shares at a price, they saw something there. Now, they have been right. They may have been wrong. They have been wrong-footed by the Fed. They may have been wrong-footed by Ukraine. But they bought at that price. Now, having said that, I think Mohan is totally right. I think, Manoj is totally right. Offer for sale has to be treated with great caution. Okay. The exiting investors are incentivized to maximize the price. The people who are not selling are also incentivized to increase the price because they want minimum dilution. The founder himself, it's a vanity metric. But I'll tell you one thing. In India, if retail investors get hurt, if the IPO is underwater, if retail investors get hurt, it is bad karma.
Yes.
You don't hurt the little guy. Okay, as simple as that. And therefore, you price judiciously. It's okay. You must leave some value on the table. Now, ideally, you want a 25-30% pop, but you can never ever predict what the pop will be. So those are market forces.
All right.
Right. So my advice to all of our companies was leave enough value on the table so that everybody wins. Those who are exiting win. Those who are staying win. The company gets growth capital, right? And those who bought in the IPO, they also win. So it's a trade-off of 4 different stakeholders.
No, sustainability of valuation was something that needs to be paramount to keep the confidence of the shareholders of the overall market. Prashant, Jain, comment on this particular point. Do you think that the confidence of the overall market has been shaken? And that's why the other new age tech company IPOs will find it difficult to gain the confidence and the kind of subscription they would look for?
See, while I completely respect what Mohandas Pai ji and Sanjeev are saying, these are extremely noble thoughts, but I think this is a free market we are dealing with, and rightly or wrongly, without getting into the ethics of it, issues are priced based on what the markets will bear. And what the markets will bear depends on the phase, the state, the sentiment of the market. And I think over time, these things tend to self-correct themselves. I mean, if valuations are excessive, supply will catch up, or vice versa. I think what has happened in a way is very good to my mind, because the larger an excess becomes, the bigger the subsequent losses would have been. So in a way, I'm happy and pleased that some sanity has returned to this space. And I think going forward, definitely there will be more pragmatism, more conservatism, both on the, part of the selling shareholders, the companies, the bankers and the investors themselves. I think going forward, we should look to saner valuations and also greater distinction between the good and the not so good business models.
I would like to respond to that, if I may, Nisha.
Yes.
actually, Prashant, this is not just a noble thought. This is very practical smarts. So I'll tell you, we listed at 320. Our offer price is 320. Now, I kept debating, in my head when you were deciding price, is this okay? Because one banker was saying 400 crore, do it 400, you'll still sell. Other banker was saying, no, 320 is okay, don't be too greedy, right? And look, you're doing an IPO for the first time. It's an initial public offering. And what you don't want is your IPO should go underwater, or it should perhaps not even be fully subscribed. So we were conservative. We went to 320. The stock hit 528 on day one. Now, part of me was saying, what a success. It's a vanity metric. What a pop. Part of me was saying, did I shortchange my current shareholders? Okay. It was subscribed 55 times, which was a record then. It was subsequently beaten that record. But I'll tell you, so I was mixed feelings, right? The stock price went up to 1,400 something in the next year or so, right? From 320. And then the global financial crisis hit. And the stock price crashed and it bottomed at 376. There were 44 IPOs in that roughly of 2 years. Only 2 did not go below the IPO prices. We were one of them, right? So we've since then done 2 QIPs. And up until now, our major goal is that anybody we sell shares to, she should not lose money. You can buy in the market and lose money. That's different. That's your call. But jab humne becha hai, when we have sold it, it should be a price where you make money.
Right.
So at no point of time in our 2 QIPs, if I remember correctly, or in our IPO ever, has the share price ever gone below that.
Yes.
And that's a great reputation to have with investors.
Right.
Because now when I call up and talk to investors, they believe us. So in the final analysis, your reputation is the only asset.
Nisha, it is good strategy not to overprice. Let me say this. It's not about getting the best price in the market. You should get the best price in the market. But what is the best price? The best price is not the IPO price. The best price is the price at which the aftermarket thinks well of you and continues to give you a good price going forward. Like Sanjeev said, let me give you some data. In 1999, we were doing that IPO in the NASDAQ. All right. I mean, I don't know whether you're born then, you're very young. 1995, we're doing the IPO. When we started the IPO, we are valued at $2 billion. When we finished the IPO, pricing date, we were valued at $3.6 billion in 15 days in the United States. And we had a full book at $37.
Right.
We had all the big banks, and we told them we don't want $37, we want $34. For 2 hours, they fought and said, nobody has ever reduced the price what you're given. We said we want to reduce it. It is only 3% of a market value because you're only raising $72 million. And that money is still in the bank even today. We listed for different reasons. Sanjeev knows that. Then we said no. And at $34, then we're sitting in front of the NASDAQ screen. It's a very famous shot of Murthy sitting. And we're wondering, there's a day of reckoning. Are we going to go back to India as heroes or zeros? Because we had $3.6 billion for 72 million. The share price opened at 52 and never came down. But we are diluting 3%. And we are bothered about the balance 97%. Will their value go down later compared to what the value was? And it paid off. And I think that is being smart. It's not about taking money from 5%, 10% of shareholders. It is making sure that 90% those to whom we are not diluting, their price remains. And the last point, I would advise everybody, you should have 8 quarters of good growth ahead of you, reasonable certainty before you go for an IPO. Because the market is unforgiving. The market is dynamic. The market, like heroes, makes you zeros tomorrow. So you've got to be very careful if you want a long-term thing. 8 quarters, because if you miss 1 or 2 quarters, but you can catch up later, Prashant Jain will still hold the stock. Now we want Prashant Jain to hold the stock for 25 years, not lose confidence. How will you make sure Prashant Jain had the confidence? You will have the confidence, say, yes, this is my judgment. But ultimately, the judgment lies in the price and whether Prashant makes money. And if Prashant makes money, never lost money, he'll always be confident. One more point I'll say, Akash Prakash in Morgan bought a stock in 1994. It became 13% of his total Morgan Stanley 1,000 crore fund. All right.
Yes.
After it, in the IPO or near after, they never came to visit us for 2 years. I asked him, why didn't you come and visit? He said, I got problems with other companies whom I bought. You are doing well. Why should I bother? See, that is trust.
No, so Mohandas Pai, in the very beginning, I asked you for these very comparisons. Probably you didn't have investors pushing you for an exit, and you didn't have investors who made the frequent rounds to pump up the price before the IPO.
Yeah,
and
true.
This was articulated by Manoj Dengla very well. And he even said pump and dump. So Manoj, what should be done to protect the interest of the minority shareholders? That is paramount for even market regulators, SEBI. And have the other stakeholders like analysts, brokerages, proxy advisors, and many other stakeholders of the overall financial markets, have they done their bit to give the right education for these new age companies to the retail participants?
So, Nisha, I think going to the point I made earlier and the point that Prashant made, there will always be excesses in the market, right? And the market participants, depending on who the market participant is, will respond to that excess in the way that suits their financial interest, right? So we can, on this forum, talk about what should be done with them, but they will behave like all financial actors will behave, right? I think given that what the regulator can do. So as I said, I'm a strong votary that if a company doesn't have a 3-year profit-making track record, do not permit OFS, because market doesn't know how to price them. Retail investors do not know how to price them. And second option which can be considered is, for a period of 3 months or 6 months, do not allow these shares to trade in a single share lot size. Increase the lot size to a larger number so that only HNIs or large shareholders can trade in these stocks. Right? If you want to protect the retail from getting hurt, or till the time that these companies have 8 quarters or 4 quarters of profit track record, say the lot size will be a much larger number. That way, you are making sure that retail investors doesn't know anything how to price these stocks, is not dabbling in these stocks. Let them participate in these stocks to Prashant Jain's fund.
Okay, so important points coming in there. So Prashant, what do you have to say about the key matrices that you look out for in these new age companies? Give us a sense of your investment decisions and how the other investors can take a cue from that and also assess these new age companies, because the KPIs were very different, and even the parameters on which they base their growth prospects were also very different, and most of them being loss-making. So how do you assess these kind of new age companies still ride the wave of scarcity premium and the tech disruption?
Nisha, it is not simple, to put down this thought in few ratios, for the simple reason that these are less mature, still evolving businesses.
Yes.
And even the operating parameters have not stabilized. I think Sanjeev is one of the most experienced people in this space. He has invested in a whole lot of companies, and his experience also has been the outcomes have been very, very diverse. So I think it yet again suggests that the uncertainty, the large range of outcomes that one is dealing with in these type of companies is not easy to model.
Yes.
And but these companies typically trade on EV to sales globally. In India, we are seeing they are trading at even higher than global multiples, given the higher likely growth rates here. But the approach that we have taken is, we have first and foremost singled out businesses that we believe have very strong competitive position. And the operating, the value add to the customer is good, and the company is increasing its bargaining power at both the ends. So at least you have these businesses that pass the test of sustainability.
Yes.
I think are the ones that one would like to invest in. Then we try and work with the range of outcomes, looking at the number of households in India, looking at the income levels, penetration levels, and then we come up with a broad range of value 3-5 years down the line. And then you, of course, discount it back and at a fairly high cost of capital, because of the uncertainty involved, our lack of proper understanding in this space. And then if it makes sense, we do participate. And we do also, to be honest, once in a while invest with participate in IPOs, hoping to make some listing gains. But that we have done in an extremely controlled environment, maybe 1-2% of the fund at any point of time. But I don't think there are very clear or simple answers to the question that you are seeking, but maybe Mr. Sanjeev.
No, your broad framework made a lot of sense, Prashant, but I'll ask you one question. Were you satisfied with the articulation of the KPIs and business matrices by most of the companies in their investor pitches?
See, I think the investor communication is very controlled, and rightly so that every investor gets the same communication. There are strong restrictions on what can be said, what cannot be said. So I think to that extent, the communication was uniform across companies. And of course, there is always a desire for people like me to learn more and more. But companies are clearly constrained by what they say. But I think these business models, most of the business models that have got listed in India have counterparts, similar business models established elsewhere. So if you adjust for the difference in evolution of these businesses in various countries, size of economy, population, per capita, I think there is reasonable understanding of the business models. The issue comes, what take rates will sustain, what margins will sustain, what market shares, how fast the market will evolve. I think the operating parameters by and large are well known. What values you ascribe to them depends, I think, varies individual to individual. And let me be honest, it also is a function of the state of the market. In very optimistic conditions, people tend to be aggressive. Otherwise, how can the same market trade at 10p one day and trade at 30p a few years down the line, or vice versa? I think, yeah.
All right. So you made many points, but one important point you made was the takeaway I will take is that many of these companies valued their IPOs much higher than their global peers. And here I would like to add, while the global peers had bigger per order value, so better economics, and on the other hand, bigger addressable market in their own hometown. Right? So these two also differentiated and stunted the growth projection that probably some of our companies gave, but they benchmarked their valuations as per the global standards and probably at a premium. Sanjeev Bikhchandani, what can be done currently for the next wave of the IPOs? Because the investors have pumped in a lot of money in the Indian companies and they will need an exit. And probably the Indian markets are the golden goose, which they may have killed.
No, I don't think any market is killed. If it is, it's not killed for a long time. Markets go up, markets go down. We saw a market crash in 2000. We saw it in 2008-9. We saw a wobble in 2015. Markets come back. As founders, as entrepreneurs, as managements, you got to keep running the business. So, one of our shareholders, after we went public, met me. And this was around 2008 or 9, right? Global financial crisis. Okay. And he gave me some advice. He said, Sanjeev, market goes up, you run the business. Market goes down, you run the business. Market goes sideways, you run the business. That's it.
All right. I was more talking about reposing faith and also taking the confidence.
Look, if the underlying fundamentals improve, faith will come back.
So I was more focusing on the valuation metrics and how to value the companies in a more sustainable manner with that respect. Because obviously global peer and premiumization on that is not something that has worked now in the hindsight.
Yeah, look, some of these companies are still evolving, right? So let me take Zomato, for example. So until 2017, Zomato was not doing delivery. It was simply restaurant listing and advertising and revenue from there. 2017, just 5 years ago, from 2008 to 2017 was not doing delivery. They began delivery and they began to scale it up. Today, it is 95%, maybe more than that of the business, right? Now, young companies, new age companies will keep on evolving their business models. And therefore, it becomes even more difficult to predict and makes Prashant's job even harder, right? Now, you got to live with that. Okay, so you go into these new age companies knowing there's a measure of risk, knowing there's going to be a measure of volatility, knowing that things could change. right? And you go in with some analysis, some belief, some faith, and some sense of adventure.
Right, adventure it has been nonetheless. But Mohandas Pai, what has been the impact?
But Nisha, I have been on the in a situation where our price went down by 75% within a few months. So it's happened earlier. We just ran the business.
No, of course. You've seen the entire cycle, Sanjeev Bikhchandani, being a pioneer. But Mohandas Pai, what has been the impact on the private market fundraising? And the liquidity is also tightening now globally. How's the fundraising spree going on there in the private market?
Nisha, good companies are still getting a reasonable price, but many people are hesitant to put more money, are having a wait and watch approach. Please remember, in the public markets rise, valuation goes ahead of value creation, market falls, value creation catches up, and the game goes on. And that is a cycle of maybe 3 years, 5 years, whatever it is. In private market, it's a cycle of maybe 18 months, 24 months. So valuation went up to an all-time high. Now people are circumspect. There's a war going. All kind of things are happening. Tightening is happening. So valuation will come down. People are circumspect. But they're looking at good companies. If the pricing is reasonable, they will invest. That is not come down. But they're not going to give you top dollars for any value. So you saw 10 unicorns from January 1 till now. 10 unicorns.
Yes.
And many of them got money maybe this month or last month when already the market was going sideways. The market was getting thunder. But we've got to be careful. But I want to answer one of the questions that you raised. Look, we are a sophisticated market in India with $3.2, $3.3 trillion. 20% of the market is by FIS, supposed to be sophisticated investors. Another maybe 20% are with institutions in this country, 20-25%. 40% or 45% are with founders, are promoters, so-called promoters, the public market. Retail is only 15, 18, 20%, excluding mutual funds, right? So we got to be careful. We don't bring in norms which drive our companies outside and clamor to list on overseas market. Nisha, out of 95 unicorns in this space, 40, 45 are domiciled outside.
Yes.
We don't want to lose them. And we want them to do an IPO here. And out of the balance, many want to do the first IPO in the US because they say they get more liquidity, better price. They don't have all these controls. They don't want to do IPO in India. Now, we don't want to deprive our investors. So we got to be very careful. Yes, we need to possibly have greater disclosure, but we got to give them norms equal to global markets because these are our entrepreneurs. And if we drive away entrepreneurs because we are too tough, we are doing this, and I think it will not serve the purpose well. And lastly, in our market, like I said, for these kind of companies, the public is only 10%. 10% is small enough. Now, if people like Prashant, Jain say this valuation is too much and they don't invest, or this so-called investors who come in first say this value is too much, then the value will be reasonable. 90% of the people said this value is okay, so the market went ahead.
So Mohandas Pai, I'll tell you one thing. With the crash in the global, new age tech companies' valuations, I think now that particular debate of, these entrepreneurs will go to US and list is totally out of the window. Global direct listing was stopped. Indian markets, Indian government gave that platform to the new age tech companies. And remember, 4 years back when we met in Bangalore, everybody was crying about not getting exits from these companies because the Indian market was not receptive to loss-making companies. The moment it opened, this is what we saw, right? So there is a debate on both the sides, and the long-standing debate of they will go to US and list, I think doesn't hold right now in the current moment.
Actually, Nisha, see, when a company flips, it usually flips early on in its life. So if it's domiciled overseas, they will not list in India.
Yes.
They by definition will list overseas. Okay. So you've got to create conditions here that people don't want to or need to flip.
Right.
Yeah. And you got to be careful.
That's a very important point, and we discussed at length about the global direct listing. But Manoj, Dengla, I want to bring about one point. SEBI has made many efforts in tightening the rules so that the shareholders' interest is protected. The disclosure, paper that has been floated. What do you think about that? And will that bring a little more sanity and give us a large part of, understanding about the companies when they're coming to the public market?
So Nisha, I can't specifically comment on the disclosure paper because both me and Mr. Pai sit on the PMAC, which approved the disclosure paper for public comment. So I can't comment on the disclosure paper. But I think I can, SEBI has been, it's to use the Hindi terminology, bhagte bhoot ki langoti, right? SEBI is basically trying to tighten screws and probably, I think that's the nature of the beast, right? Trying to catch up to what's happening in the market. So I think the initiative by SEBI is good. And depending on how the market evolves, you might see SEBI take more initiatives. One thing which I just wanted to tee up for this group is governance and in these companies before they are public and after they are public, right? We have seen multiple instances of a lot of these companies which are unicorns, some of them are decacorns, the way the business practices they follow, the governance practices they follow. And some of the investors in these companies, VC investors are friends, and when we talk in the private market, in like,
Yes,
and they say, we do not care, right? If we ask founder a hard question, we won't get invited to the next round in the next company, right? And that when these companies make the transition to public markets, they will get questioned. And I'm not sure a lot of them have thought through it or even thinking about it or are ready to answer those hard questions which will come from public market, what the business practices they follow. And yeah, so I think that's an important transition and will take time.
Right.
Nisha, maybe one point I want to add to what maybe what we require now is for a minimum period of 1 year before the list, they should have all the corporate governance practice of public markets so that there's some stability in the corporate governance. The corporate governance is not something that you can order about or you can get it done. It doesn't work that way, all right? It all depends on many factors. At least for 1 year before the list or the actual date of listing, if they've got some, all the committees, they've got good people, which may not happen at all, but it's better than zero, they're matured, then I think, the probability goes up by maybe 10, 20%, from let's say 40 to maybe 60%. That's better than 40%. What do you say, Manoj?
Mohandas Pai, I would say you incubate and mentor so many of these startup founders, probably start at the very beginning with the corporate governance standards and sustainability trust and incorporate it from the very beginning so that while they are bigger, it's already inbuilt in their practices. Prashant, Jain, final word to you. Anything you think needs to be done from the market regulator point of view and from other stakeholders, which can bring much more sanity, and the new age tech companies with confidence can still come to the Indian market and raise funds in future because they do have a business case in the digital revolution phase?
Well, I think the regulator has to clearly strike a balance, and there are no easy answers, because I fully agree with what Mr. Mohandas Pai said earlier, and Sanjeev also agreed to that we need to encourage these companies to list in India. And I think that should not be lost sight of. What I have experienced is that whenever a new business model evolves, whenever a business model is new to the markets, like it was infra, for example, in 2007-8, there are excesses that are created, but these excesses do get fleshed out over time. So I think free market should be allowed to operate. And of course, for the retail investor, if something is deemed necessary, you can bring in some protection, but it is debatable whether we can sit in judgment and say that the small investor is not as intelligent, or in some cases even more intelligent than the larger institutional investors, because in these excesses, even institutions have often been caught on the wrong foot. Yes. So I would say, we should respect market forces by and large, and we should encourage more disclosures. And some of the points that have been made, they could be considered by the regulator.
Okay, thank you so much, Mohandas Pai, Sanjeev Bikhchandani, Prashant, Jain, and Manoj Dengla. Very, very riveting conversation. I am thankful to each one of you for being so candid and speaking your mind out, and so many takeaways and learnings from the IPO frenzy in the new age tech companies that we saw, and probably looking for those lessons learned and better IPO season next time around. With that, I wrap this conversation. Thank you so much. for joining us, and I hand it back to the organizers and thank them for the opportunity given.
Thank you so much.
Thank
Thank
you.
you. Thank you.
Bye, Sanjeev.
Bye-bye.
So I think we still have a few minutes left, and I would like to take the opportunity of getting some question answers done during the next 3-4 minutes. Right. So any physical participant here would like to raise a question, I think we can do the first choice because you're all here. Right. Request all the panelists to maybe stay put for at least to 6 p.m. because once you are there, we don't want to let you go off so soon. Right. So any questions here? Yes, please. Yeah, so while the questions here are still coming in, I would like to pick up some of the questions from the Q&A blog. I saw some questions which was talking about the fact that investors actually trust the investment bankers and others who do retail valuation, especially the retail investors. And then once the stock lists, we always hear a lot of negative information depending upon the sentiment. Is there something we can do as small investors to guard against these kinds of dangers? Is a question I saw somewhere down the line where I was scanning through it. So if any of you can take that answer.
Mr. Pai, you want to take that?
Yeah, sure, I can take that. Let me say this, okay? There is no market that guarantees so-called small investor that they'll always make money in the market. When you come to the market, you take a risk. The risk comes along with the reward. Now, the reward can also be a loss, right? You're taking a risk. And the pricing is what a knowledgeable, willing seller will sell to a knowledgeable, willing buyer. Nobody is forcing small investors, any investor, go to the IPO market and to invest. Let's be very clear about that. It's a capitalistic market. There are buyers, there are sellers, and you come there because you want to buy, you want to sell, you want to trade. All we have to do as regulators and others is to make sure there's adequate disclosure, there is true disclosure, there are certain standards of governance that are put in, and these have to be done to prevent manipulation, prevent pump and dump, or whatever Manoj said, which is very correct. And that is it. And if you go enter there, you make money, you're not going to praise SEBI. Now, if you make losses, why do you want to criticize SEBI as the regulator and say, hey man, you didn't allow me guarantee my profits? So let's be clear about that. And I think that's the norm we have to follow. And if so-called small investors feel that they have been shortchanged, they should not invest in the IPO market. Let the institutions invest, let them put money into the funds. And that is fair enough to diversify. Manoj?
I agree with Mr. Pai. There is no reward without risk. And if small investors cannot read the DRHP, and that's one of the questions I'd asked SEBI in one of the Mr. Pai's one of the PMAC groups. Can you track the number of times a DRHP is downloaded versus the number of applications? It will be a fraction. It won't even be like 1%. So a lot of investors come in the market, apply for IPOs without even needing the DRHP. So they need to live with the risk.
Yeah, maybe they can differentiate between the product they use or the app they use and for transferring money compared to putting in and investing money for returns in them. So there is a differentiation between a brand that you use normally and the brand that you want to invest in and make money out of.
And Nisha, I'll just say one point. The pricing is not always determined by long-term investors.
Yeah.
Pricing in an IPO or even on a stock on a day-to-day basis when it trades is determined by the short-term move in the market, the short-term traders in the market. So in the bull market, which you saw till a couple of months ago, when it was a unidirectional market going up, everyone saw the market is going up. People will come in, buy the stock in the morning, sell it 2 days later, make money, right? In a market like this, when it's going down, people will short the stock, square the position in 2 days, right? So one needs to be very clear what their investment time horizon is. If the investment time horizon is to make short-term flipping gains, then it comes with the risk. If the time horizon is I want to be a long-term owner of this company, then one needs to evaluate this company with a very different lens. And my sense is, at least in the IPO frenzy of last year, a lot of investors' time horizon was, what is a gray market premium? Can I flip it? But from the time they put the application till the time the stock listed, it corrected, too bad for them.
Nisha, one thing that maybe people should look at, lending for investing in stock market, which probably create a very highly inflated oversubscription. If people have to put their own money, maybe not borrow too much, some money is available for lending, then the market will be more balanced. Because today, based upon who is manipulating the price in the so-called unofficial market, people borrow with 5%, 10% margin. That lever for oversubscription is too high. And
I am so glad, Mohandas, why you made this point, because the first day pop is what a lot of investors look out for, and then they got caught in one such IPO because of that particular problem. But RBI has tried to fix it.
Yes.
From 1st of April, and hopefully there'll be sanity post that.
Yeah.
So thank you, sirs. Thank you, all of you. And we would like to thank the audience, thank the panelists, thank our wonderful moderator, and thank you, all of you. Thank you very much.
Thank you. Thank you, folks. Thank you, NISM. Thank you, Nisha. Wonderful session. Learned a lot. Thank you. Thanks, Manoj.
Bye. Bye.
Always to the point, direct, Manoj. Thank you very much. Thank you. Always to the point. Manoj is always like that. Thank you. Thank you, folks.
Thank you. Bye. Bye.